the market is, I mean, the bottom line is all of the futures, options, paper products, etc., they're all based off of the physical metal in the first place anyway. That's why they're called derivatives. They're derivatives of the actual product. Uh, the, there's not as much concern. There's concern. I mean, if gold were to go, if gold doesn't deliver, the system dies anyway. But if gold doesn't deliver, it's not a direct effect on production, if you will. Silver is used in so many different applications, whether it be industrial, technological, medicinal. I just did an interview and was talking about every time they shoot a Tomahawk missile, there goes a monster box. You can't make a Tomahawk missile without roughly 500 ounces of silver. So silver will have profound ramifications to the real world, to the real economy.
Gold was considered a relic in the age of digital finance and central bank omnipotence for decades. But beneath the surface, the world is seeing one of the biggest financial reversals ever. The same institutions that formerly called gold unprofitable are now quietly hoarding it. Central banks have led the way, repatriating reserves, boosting holdings, and signaling to watchers that unbacked currency trust is fading. This trend goes beyond sovereigns. Major financial organizations, the authors of the 60 Fortits portfolio philosophy, are advising clients to prefer gold over bonds. Their logic is simple but devastating. The risk-free yield is finished, and another wave of global money printing on an unprecedented scale is coming. Whether officials term it quantitative easing or something else is irrelevant. Results will be identical. Devaluation of all fiat currencies and real asset repricing. Bill Holter brings this argument to its conclusion. He believes that when the financial sector realizes that half of the global bond market must be traded for gold, the math indicates exorbitant valuations. His prediction that gold may reach $2 million an ounce is a mathematical extrapolation of supply and demand. Gold would not simply be revalued in a world of paper claims and declining faith. Repricing would reflect a century of repressed purchasing power and structural overleverage. The significance of this waking is immense. Policymakers and bankers who formerly dismissed gold are now recommending it as a basic holding. This is structural rotation, not speculative mania. Capital from paper promises to concrete value. Silver, in gold's shadow, will profit from its monetary heritage and industrial demand when gold reclaims its role. The global reset is bringing the two obscure metals back into the spotlight. Bill Holter explains why this rotation is a survival mechanism, a shift from synthetic wealth to genuine money. We'll analyze his estimate of the physical market's supremacy over the paper system, the liquidity constraint, and the once-in-a-generation opportunity for early investors. Please like, subscribe, and share this comprehensive study with precious metals market watchers if you find it useful. Thanks, and enjoy the video.
And again, we're back to the high levels, not quite on gold, but yes, on silver. But neither silver nor gold are as overbought as they were 3 weeks ago. So they worked off some of the overbought. The paper sales did not work in I mean, yes, they got a short-term pullback, but it didn't work like it had in the past, where you get a smash and, it's another month, 2 months, 3 months before those numbers are revisited. I mean, this was amazing that the metals have, they pulled back basically to where they should have on charts, relieved the overbought, and here we are again, not as overbought as we were before. And in silver, well, in both, in gold and silver, you're starting to see some global price insensitivity. They don't care about the price. They want the ounces. And thanks for having me on. I cut your introduction off, so thank you for having me back, Donegan.
Absolutely, you're always welcome. And you're talking about the dominance of the physical market over the paper market, which has been the opposite for the past several decades. Can you explain that to people?
Yeah, I mean, the paper markets were the tail on the dog, but the tail constantly wagged the dog because they would overwhelm the physical markets with paper. The problem now is they've done it for so long and to such a grand extent that now there's a question whether these paper contracts are going to be able to deliver. And the answer, I think, you're going to find in the next month to 3 months, we're going to find out that no, the paper markets are not a substitute for real physical because they have to deliver real physical that does not exist to be delivered. I mean, the market is, I mean, the bottom line is all of the futures, options, paper products, etc., they're all based off of the physical metal in the first place anyway. That's why they're called derivatives. They're derivatives of the actual product. There's not as much concern. There's concern. I mean, if gold were to go, if gold doesn't deliver, the system dies anyway. But if gold doesn't deliver, it's not a direct effect on production, if you will. Silver is used in so many different applications, whether it be industrial, technological, medicinal. I just did an interview and was talking about every time they shoot a Tomahawk missile, there goes a monster box. You can't make a Tomahawk missile without roughly 500 ounces of silver. So silver will have profound ramifications to the real world, to the real economy. Now, that said, if silver goes failure to deliver or gold goes failure to deliver, you're stuck in the casino because the casino will close. And when the casino closes, and we've talked about this, for the last, year and a half, maybe even 2 years, we've talked about the great taking. Once the casino closes and banks and brokers and insurance companies start going belly up, they're going to take your capital with them. And that's why it's so important to get your capital out of the system into something, gold and silver, that cannot bankrupt, and in a place where it can't be taken from you. Right. Well, going back to visit the late 2019 episode, that was just before COVID, and the repo rates spiked to 10%, and that the Fed was having to put $100+ billion into that market every single night so it could clear. Then conveniently along came COVID, and two things happened. The real economy worldwide was definitely stunted or shut down, whatever you want to call it. There was less demand for credit because of COVID, and it allowed central banks all over the world to flood the markets with liquidity. Problem solved. Not solved, but the can was kicked down the road. Here we are again. We're nowhere near where we were in October of 2019, but the overnight rates are starting to move higher again. It's a concern and should be watched. Again, everything, whether it be the real economy, production, consumption, transit, and also the financial world, the financial economy, everything runs on credit. If credit gets disrupted or credit ceases anywhere, it'll be a shock that will it'll shut the whole system down.
Next, Bill Holter discusses the final battle between paper markets and the metal they represent. Futures and derivatives set gold and silver prices for decades. This imbalance has reached critical mass despite these contracts' finite physical basis. Holter says the system has been bloated for so long that true metal delivery is questionable. Paper substitutes lose credibility immediately after that failure. The cascade effect would cripple derivatives markets and reveal the weakness of the banking system. Holter remains amazingly grounded despite this systemic breakdown. The behavior of silver investors and long-term holders. His description of junk silver, 90% silver pre-1965 US currency, shows the grassroots level of this monetary shift. The market for small denomination silver is exposing something deep about scarcity, utility, and real-world demand while the economy struggles with credit dislocation and liquidity stress.
We have interest rates still at basically generational lows. I mean, we're not where we were 3 or 4 years ago. We're not at 0% rates, but rates are extremely low. There's no risk premium in interest rates at all. So brokers and banks, they understand that the likelihood long-term, 5 years, 10 years, longer than that, the likelihood is that rates are going to go higher, not lower. And they also understand that there's going to have to be another mass printing, whether they call it QE or not, it doesn't matter. But there's going to be another global mass printing. And the problem with that is that debases the currencies, and that lowers the value of the unbacked currencies. If the values are lower, then you got to give more of dollars or euros or yen or whatever for that same ounce of gold or the same ounce of silver. So I think they're looking at it pragmatically and saying, yeah, the day of buying and holding bonds is over, and that's why they're recommending half of that bond position be liquidated and put into gold. The only problem with that is if everybody did that, you'd have gold at probably, who knows, $2 million an ounce. Just pick a number, but it's going to be super, super high. There's always some risk. I think the risk will be greater as the prices go higher. And I would simply say, either call me or call you. We clear our business through Miles Franklin, and Miles Franklin's been in business over 30 years and never had, they have never delivered a counterfeit coin. As far as I know, has never delivered one counterfeit coin to a customer. And if it was done, it was rectified. But understand that if you go through a reputable broker, their business is done. If they send you a counterfeit gold eagle or gold bar or silver or whatever, if they send counterfeit to you, their business is done, because then their reputation, their word is broken. So I would just say, and do understand that any time metal is shipped out, it's done 100% under camera, and the coins that they receive, other than coins directly from the U.S. Mint, it's my understanding that all coins are assayed and proven to be real when they come in before they go back out. So if you use a reputable dealer, use us, Miles Franklin, you're going to get the real deal.
Any particular products you can identify that you think will be likely to be the targets of potential forgery attempts because it's easier for the forgers, or the payback is great, the potential payback for them is greater?
Well, I mean, the payback in gold is obviously greater than the payback in silver. So gold is going to be the target. And I would say either generic rounds or bars are going to be the easiest to, they'll be the easiest to counterfeit. I mean, it's more difficult to counterfeit an elaborate coin, but yeah, they can be counterfeited. And that brings me to a topic I want to talk about. In silver, I've been an advocate of junk silver as the best form to own in the United States. Roughly 14 dimes equals an ounce. So you've got 14 transactions. It's the smallest denomination. It's U.S. Mint lineage. It really can't be counterfeited because it's got to show scruffiness. I mean, these were in people's pockets. And we've got an anomaly going on right now where if you're looking to sell junk silver, you're looking at $3.50, $4 under spot. And if you're looking to buy junk silver, you can buy it at spot, maybe 50 cents over spot. It's the cheapest form that you can buy right now. So if you're buying silver, you definitely want to buy junk silver. It's the cheapest and it's the best. And if you're worried because the bid is below spot, and it's well below spot, pretty much everything else is very close to spot, or even eagles are above spot. Understand what has happened. We finally got back to this $50 level, and we stayed here. We've been here for, call it a month, but we're approaching it. And literally, I'm not going to say the only form or the only way to buy silver in the late 1970s, early 1980s was junk, but that was by far and away the primary form of silver to buy. So what you've seen over the last few months is that many of these people who have held on for 40 plus years have turned seller. And the dealers and the wholesalers got overwhelmed with the selling. So what did they do? They lowered the price. And if they're, call it $4 under spot, that's 8% below spot. And what they're doing is they're sending those coins into refiners to melt them down. And they pick up that 8% is what they're doing. Now, that said, this is a short-term event because the supply is already, the supply of junk being sold is already starting to dry up. And when it does dry up and prices start to normalize, guess what? There's way less junk available that still exists because it's been melted down. And I'm gonna say right here that I think when all is said and done, junk silver is going to become the most expensive form of silver in the United States, even priced higher than Eagles. And I say this because I believe the supply is being destroyed on a daily basis. It's being melted down.
Holter claims that junk silver may be a viable financial insurance option again. These circulated coins, once considered outdated and inconvenient, now represent everything the modern financial system lacks: authenticity, divisibility, and tangible. No one can readily fake these. Trackable origins and a trusted U.S. mint lineage. This is the closest thing to functional money outside the banking system for investors wanting transactional freedom in an uncertain future. Holter's observation is even more startling because junk silver, currently discounted relative to spot, may soon become the most costly type of silver, after the oversupply from decades-old holdings is melted down and disappears. Melting ancient coins into industrial feedstock symbolizes a deeper truth. Even as industrial and monetary demand rises, real silver stock is declining. Silver is essential in modern production, from solar panels to missile guiding systems. Lost coins are lost forever. Supply decrease might fundamentally change the silver market. Holter claims that shortages will be systemic, not merely numerical. Lasting decrease in verified, deliverable silver. Sobering ramifications extend beyond the silver market. The financial system still assumes endless liquidity, and that counterparties will always give credit. Holter reminds us that the global economy is credit-based. If credit ceases, the system can shut down in days. The 2019 repo crises and emergency actions were not isolated. They were early signs of a market losing confidence. He cautions that the next liquidity shock will be far worse and harder to handle. For attentive readers, the prescription is straightforward yet urgent. Transfer capital from paper to non-defaulting, confiscable assets. Here, gold and silver are not speculative. They are lifeboats in a leveraged, depleted system. Institutions that mock this argument now silently follow it. Rotation from paper to metal has begun. History shows that such a transition accelerates violently and irreversibly. If you enjoyed this research, please like, share, and subscribe for more precious metals analysis. Comment your thoughts. How do you envisage global awakening unfolding? What are you doing to prepare? Thanks for viewing and stay tuned for more enlightening deep dives.